fund can pay you cash every month and still leave you poorer. That is the uncomfortable story inside the Global X Super Dividend ETF. SDIV has delivered a long stream of distributions, yet its capital base has been badly wounded, its payout has moved lower, and even reinvesting the cash has not fully repaired the damage. This is not an autopsy of whether the checks arrived. They did. It is an autopsy of what those checks cost. Today we are dissecting the Global X Super Dividend ETF, ticker SDIV from Global X. The sales pitch is easy to understand. Take a broad global portfolio, screen for securities with high dividend yields, hold a large group of them in roughly equal slices, and send investors income every month. Underneath that simple pitch is a more complicated machine. SDIV tracks the Stuttgart Selective AG Global Super Dividend Index, an equal-weighted index of 100 global securities with high yields. So this is not a plain position in the largest, strongest companies on Earth. It deliberately searches the global market for unusually generous payers, with the portfolio landing in the global small/mid stock category. The fund is also described in the supplied strategy data as using an options income approach. That means the payout can be fed by more than ordinary company dividends. Option premium may add cash, and some distributions may represent capital being handed back to shareholders. Those sources can make the monthly deposit look sturdy even while the investment underneath is losing strength. Think of SDIV as a machine built to maximize visible cash flow, not necessarily to preserve every dollar fed into it. Our job is to separate the output from the wear on the engine. This video is for research and education only. It is not financial, investment, tax, or legal advice, and it is not a recommendation to buy, sell, or hold SDIV or any other security. ETFs can lose value, distributions can change, and tax treatment can vary. Verify the current prospectus, shareholder reports, distribution notices, holdings, and other fund documents for yourself, and consult a qualified professional who understands your circumstances before making any decision. Let's check the vitals. SDIV launched on June 8, 2011. It pays monthly, charges an expense ratio of 0.58%, and has $1,220 million in assets under management as of August 5, 2026. That asset base tells us this is not some tiny experiment hiding in a dark corner of the market. Investors have entrusted substantial money to the promise of global income. The monthly schedule also has obvious appeal for anyone trying to match portfolio cash flow with regular expenses. But frequency is only a calendar feature. A monthly payment is not automatically a durable payment, and a well-established fund is not automatically a successful investment. The fee matters for the same reason. A specialized global screen, portfolio maintenance, and income machinery cost more than a bare-bones market tracker. Investors therefore need the strategy to create enough value to cover not just market risk, but its ongoing operating drag. The relevant question is not whether the fund is real, liquid-looking, or convenient. It is whether the whole package has rewarded the capital that stayed inside it. The honest income number to lead with is the current run rate, 9%. That is based on annualizing the latest 4 payments, assuming those payments repeat. The trailing 12-month yield is also 9%, and annualizing the single latest payment gives the same 9%. In other words, there is no stale headline gap here. The recent pace, the longer backward-looking window, and the most recent check are aligned. The latest distribution was 18 cents per share. That is meaningful income, but it is not a magic coupon. An ETF distribution is cash leaving the fund. What determines whether that payment enriches the investor is what happens to the value of the remaining shares. If the portfolio earns enough dividends, gains, and premium to support the cash, the payout can be productive. If the fund must sacrifice capital or own securities whose prices fall faster than their dividends compensate, the yield can become a very efficient way to return part of the investor's own economic value. That distinction is especially important with high-yield screens. A security can qualify because its dividend is strong, or because its price has already fallen while the quoted dividend has not caught up. The percentage looks generous in both cases, but the second case may be a distress flare wearing a party hat. SDIV's yield is the starting point of the investigation, not the conclusion. Time for the history. The first 4 distribution average was 27 cents per share. The latest 4 average is 18 cents. The authoritative direction is down. Recent payments average 68% of those initial launch period payouts. That decline matters because an income investor often plans around cash flow. A lower payment does not merely reduce bragging rights on a brokerage screen. It can leave a retiree with less spending money, force the sale of additional shares, or require more capital to pursue the same income target. Monthly frequency softens none of that. It also changes how we interpret the present run rate. Today's figure may accurately describe the recent pace, but history says the amount paid per share has not been fixed. The fund has already demonstrated that management and portfolio economics can deliver less cash over time. A prospective buyer should therefore model the distribution as variable, not as a bond-like promise. To be fair, reducing a payment can be healthier than stubbornly funding an unsustainable one. A cut may protect more of the portfolio for future recovery. But that defense only works if the retained value begins to stabilize the investment. Here, the distribution path has weakened alongside a much larger problem in the share value path. The patient is receiving less cash while the underlying body has also lost weight. Now, we reach net asset value, the cleanest place to see what happened to the capital inside the wrapper. The latest NAV or price is $24.69, compared with a launch reference price of $39.60. The NAV return since inception is negative 38%. That is not a harmless wiggle. It means the fund's share value ended far below where this story began. An investor who focused only on monthly deposits could easily miss the scale of that deterioration because cash arriving feels like progress. NAV erosion is quieter. It appears as a smaller base generating the next round of income. The maximum drawdown was negative 56%. At the worst point, the experience was not simply high income with some volatility. It was a severe loss of quoted value. That matters behaviorally as well as mathematically. Many investors discover their true risk tolerance only after a large decline has already arrived. Selling during deep stress can convert a temporary mark into a permanent loss, while holding requires confidence that the strategy can recover rather than merely keep distributing from a damaged base. There is another consequence. When NAV falls, the same cash distribution can produce a higher-looking yield percentage because the denominator is smaller. The screen can therefore become more seductive as the capital condition worsens. A rising-looking yield on a falling asset is not automatically improved income. Sometimes it is the market demanding compensation for risk. Sometimes it is arithmetic applying lipstick to a shrinking account value. Price alone would be an incomplete verdict because SDIV has paid substantial cash. Since launch, cash distributions total $13.85 per share. Giving the fund credit for that income produces a simple distribution-inclusive return since inception of negative 3%. That result is better than the price chart alone, but it is still below zero. The monthly checks repaired most of the capital loss, not all of it. This is the central lesson of the case. Income and return are related, but they are not interchangeable. Compare the experience with holding cash-producing assets in general. A successful income strategy should ideally let the investor consume some distributions while preserving enough capital to survive different market regimes. Here, anyone who spent every payment would still confront the diminished share value. Anyone who mentally treated each payment as profit would be overstating what the investment accomplished. The full ledger says the capital and cash together failed to get back above the starting line. This also reveals why yield-on-screen comparisons can mislead. Another fund with a lower current payout could leave an investor with more wealth if its price and distributions combine into a stronger result. Conversely, SDIV could improve from here if its portfolio stabilizes and future cash is supported by real economic earnings. But the historical burden of proof is now high. The strategy needs to show that future distributions are being created, not carved out of the furniture. Here is the machine under the hood. SDIV owns a global, equal-weighted basket selected for high dividend yield. Its listed top positions are Thai Foods Group PCLNVDR at 2%, Hureg Autoliners ASA, ticker HAUTO, at 2%, Robert Half Inc., ticker RHI at 1%, Nordic American Tankers Limited, ticker NAT at 1%, VAR Energy ASA, ticker VAR at 1%, and Bradshaw S.A. at 1%. Those names show what global high yield means in practice. This is a mix of businesses, industries, and markets rather than a familiar domestic blue-chip club. Equal weighting prevents a single giant company from dominating the portfolio, but it also means smaller and riskier constituents can matter more than they would in a market cap-weighted index. The screen is deliberately attracted to high payouts, which can uncover neglected value, but can also pull the portfolio towards cyclicality, financial stress, commodity sensitivity, or companies whose dividends may not survive a downturn. The first income source is straightforward. The underlying businesses distribute cash, and the ETF passes portfolio income through to shareholders. The second source, according to the strategy description provided here, is options income. Option positions can collect premium in exchange for transferring some favorable market outcomes or accepting defined market obligations. That premium is real cash, but it is payment for taking risk, not free extra yield. If the fund's option exposure sells away some upside, a strong rally can leave the portfolio participating less fully than a plain position. If the relevant assets fall, premium may cushion part of the decline without erasing it. The trade is income now in exchange for a less favorable payoff somewhere else. The exact effect depends on the contracts and positioning disclosed in current fund documents, which is why investors should inspect those documents rather than assuming every options income fund operates identically. Then there is return of capital. From here, watch the fund like an examiner, not a fan. Start with the next distribution notices. Are payments stabilizing, or does the recent average keep moving lower? Then compare those payments with the NAV path. A healthier pattern would be cash continuing without another persistent decline in the asset base. Read the current holdings and index methodology for changes in sector, country, and business quality exposure. A high-yield screen can change character as market prices move. What looked diversified by ticker count can still become concentrated in the same economic risk, such as commodity prices, shipping conditions, credit stress, or weak global growth. Inspect the fund documents for the actual source of each distribution. Separate ordinary portfolio income, option-related cash, realized gains, and return of capital were disclosed. The label alone does not settle the issue, but the source mix tells you whether the machine is earning, trading, realizing, or returning the money it pays. Finally, judge future reports on total return, not yield in isolation. Ask whether the capital plus cash is advancing after expenses and whether the strategy is recovering from severe declines. A payout that arrives on schedule can be useful. A payout that steadily consumes its own foundation is a withdrawal plan disguised as investment performance. On life support, that is the assigned verdict. SDIV deserves credit for doing the visible part of its job. It has delivered monthly cash from a diversified global income portfolio, and its current run rate is supported by multiple recent measurement windows rather than a stale headline. But the long record shows an investment struggling to keep its capital alive. The payout has been cut from its launch period level. The share value path is deeply negative, and including all the cash still leaves the investor slightly behind. This does not mean every future payment is doomed or that no informed investor could ever use the fund. It means the burden of proof has shifted. SDIV must demonstrate that its distributions can be supported without further sacrificing the asset base, and that its global high-yield selection can produce a durable recovery, not merely another round of cash extraction. For everyday investors, the cleanest conclusion is simple. Do not confuse receiving money with making money. In this case, the checks kept coming, but the body underneath them never regained full health. Two quick things before you go. If this teardown helped you see past the headline yield, hit the like button. It genuinely helps the channel. Subscribe so the next ETF Autopsy lands in your feed. And drop a comment. Which ticker should we put on the table next? And where do you think the real risk is hiding? We read everyone. Thanks for watching.